Hey, Sub2ers. My name is William Tingle of Sub2Deals.com. I'd like to welcome you to this episode of the Sub2Deals Show, where we talk about all things subject to. Now, of course, you know, from time to time, we go down a rabbit trail and we talk about some other stuff, but it's always something real estate related that will help you with your business. Today is the first episode in our new Real Expert series. From time to time, we're going to bring on some people here that are experts in different topics. And today, we're going to kick that off with somebody you guys are very familiar with, our friend Bill Walston. Bill is in the Johnson City, Tri-Cities area of Tennessee. And gosh, what is it that you aren't an expert on, Bill? Creative finance, taxes, master lease options. I mean, you're just kind of a one-stop for
Jack of all trades, man. Jack of all trades. What can I say?
There you go. But Bill's going to talk to us today about something that I've heard more about recently. You know, and that's the Roth IRA, Roth 401k, and specifically we're going to try to talk a little bit about how you can utilize Sub2 with this wealth building tool to help you when you get old. So, you know, for those of you who aren't already old,
I hear you. Listen to you.
You know, some of us may have that ship has sailed. I don't know, but anyway, so we're going to talk a little bit about that today. So, Bill, once again, welcome to the Sub2Deals Show.
Thank you, man. I appreciate it.
Yeah, good to have you on here today. Listen, you know, all of my investing life for 21 years, I guess, getting on to 21 years. The Roth IRA was the thing. You know, that's what everybody talked about. That's what everybody used. And it seems like the last couple of years, I hear more and more people say, no, don't use the Roth IRA, use the 401k. So Tell me why it is so great, why it's superior.
Which, the Roth or the 401k?
Well, I mean, you know, which is it? Lately it seems like more people say the 401k is better.
And I really think that it depends on where you are in your business. Okay? Because in order to have a 401k, you have to have a business. And it has to be set up, it has to be taxed that way. Now, that business can be a sole proprietorship, all right, because they now have solo 401ks. And probably the reason you've been hearing it in the last few years is that they've just become popular in the last few years. It used to be that all 401ks were pretty much employer sponsored, right? And you had to be a big organization type thing to handle that. Now, you know, just someone who has a sole proprietorship files a Schedule C can have a 401k. Okay, it's solo 401k. Now, there is some debate at this point as to how real estate investors would qualify for that 401k, because in order to fund it, okay, if you're depositing monies into your 401k or even into a Roth IRA, that money has to come from earned income, right? So money from rents, okay, interest, capital gains, that's not earned income. That can't go into a 401k as a contribution. Now, the 401k, of course, can earn those types of income, but you can't establish a 401k and you can't use that to contribute to the 401k, if that makes sense, right? So some businesses don't earn the type of income in order to set those up, okay? And somebody says, well, can't you do a 401k with W-2 income? No, you can't, right? So if your only earned income is from a W-2 job, you may not qualify for a 401k.
Well, let me ask you this. Let's just say that you did something or whatever to maybe flip the house, I suppose, or something like that, because flipping is considered earned income.
Flipping is earned income. Yes, you're absolutely correct. So if you're nothing but a wholesaler, okay, and you are doing flips and you rise to the level of being a dealer and having dealer income, and your accountant properly reports that because it should be reported on a Schedule C, you absolutely would qualify.
Okay. So let's say that you decide you want to open a 401k, you're a business, you qualify in all those areas, and you need money to make a contribution. You could go out, flip a house, make 20,000, stick that in your 401k to get started with. I mean, if you make one contribution and never make another one, correct?
Oh yeah, you
Yeah.
can.
So you
But
can
with a
fund it.
with a 40 in that case, I would suggest a Roth IRA.
Right. Okay.
Because your 401k, they're looking for earned income to supplement that type of stuff and the annual reports and that
Right.
type of thing. So it's pretty much one of the big things I would say is that if you are not a business, then don't try to do a solo 401k.
Okay.
Okay, if you're not an established business, that's my personal opinion. All right, you would be better off with a Roth, because what you're talking about is like a one-time contribution, right? So you wouldn't need a 401k. That's a tax-saving vehicle, okay, for businesses.
Okay.
Okay, tax-saving.
Let's make this simple, because simple works for me. First of all, I don't like tax stuff. Okay. I have to, keep poking myself with a pen in the palm of my hand to stay awake.
Yeah,
But
man, that stuff
secondly,
gives me goosebumps. I love
okay.
it.
All right, I tell you what, let's really drill down here on this thing. I'm a sub-2 investor, and unless 100% of what I do is taking overpayments, selling with seller financing. Let's say that I am, like most people that are going to be listening to this, that majority of my business is sub-2s. I take overpayments on loans. So an investor operating in that type of situation, what do you recommend that they use?
Roth IRA.
Roth IRA. Okay.
Mm-hmm.
So the 401k may be better in some aspects, but for the sub-2 investor who focuses primarily on taking over payments on existing mortgages and either selling with seller financing or possibly renting, whichever they do, whatever their flavor is, the Roth IRA is still best.
Okay. Some people would argue with it. That's my opinion, because what you're talking about, William, I don't see a lot of contributions into the entity, right? Into the retirement entity, right? So my thing is, why run into the administrative problems? Okay, having to self-administer, having to have the IRS approval for the 401k, because it requires approval. IRAs do not require IRS approval. 401ks do. You have to have a plan that's reviewed annually to make sure it still meets all the IRS rules and regs. Okay, why subject yourself to that if you're not going to use it to take in these, the extra income that you would make, right? Now, that applies if you're one of those investors who don't get a lot of earned income. Okay, if you're making a lot of earned income, then the 401k might be more advantageous, because you have a larger tax deduction when you contribute. You can contribute more into a 401k than you can into a Roth IRA. So if you've got if you're a high earner and you've got quite a bit that you need to shelter from taxes, earned income you need to shelter from taxes, then the 401k might be better for you. Okay, so it's going to be a case-by-case basis. It's very difficult sometimes to say, oh yeah, this works better than this does, because it varies from individual to individual. Okay, so in your set of circumstances, if you don't have a lot of earned income, a large amount of earned income that you need to shield, okay, then I think the Roth IRA would be better. If you have a great deal of income and you're going to be willing to stash that income into a vehicle that you can't use the money, right? Okay, then I think the 401k would be better.
Right. Okay. So
But that's just my opinion.
As with most things, well, you're the expert, so that's why we're asking. As with most things, one thing being better over the other depends.
It does.
It depends.
It's circumstantial.
if
right?
you're in general, if you're probably a flipper or a rehabber or something along those lines, the 401k would probably be better.
Would probably be better.
Okay, I got you.
Absolutely.
I
Yep. And
get
then
it now.
somewhat, so if you're getting a lot, and I guess you'd put it down to this: if you have an established business and most of your income is earned income, lean towards the 401k.
Right.
If most of your income is passive income and you get just a bit of earned income every now and again, then lean towards the Roth IRA.
Okay, I think we got it there now. So having that been said, that probably the Roth is going to be your best way to go if your specialty is acquiring subject to and either renting or selling with seller financing, whichever you do. So I'm a sub-2 investor, and I decide, you know what, I want to put a couple of properties a year in a Roth IRA, go through that with it. How would that work exactly? What do you think would be the best way to handle that?
Okay. So here's the nice thing about sub-2 deals. I think a sub-2 deal is perfect to go into an IRA or a 401k. I just think they're great to go into a retirement plan, and here is why. It doesn't take a lot of money to do a sub-2 deal.
Right.
Okay, which means that you don't have a lot of money. You don't have to have a lot of money in your IRA, right? So you could have just the basic amount of money in your IRA, and once you've got that IRA set up, you can transfer the deed. Well, you can't transfer it. You can take the deed into the IRA. Okay. Now, the way that would work is, let's say you find a deal. William, you can find the deal. Let's say Jody had a property. This is before y'all got married, because now it would be a prohibited transaction, right? But
Okay.
before you got married, okay, you could actually, if she had a property that you wanted to take over sub-2, and you wanted that property to go into your IRA, rule number one is do not put that purchase and sale agreement into your name as an individual. Okay, can't do that. I hear people talk about, oh, I'm just going to contribute my property to my IRA. Can't do that. Okay, just so you know, contributions, whatever is considered a contribution into an IRA, has to be in cash. Right. Period. Okay, so you would find the property, and then you would get the custodian of your IRA to enter into the purchase and sale agreement, or to take the deed. Now, you know, old school, you and I don't do purchase and sale agreements, right? We just take the deed, okay? But there are some situations now where a lot of people are being taught to, oh yeah, you can do a purchase and sale agreement with a sub-2. I've taught people to do it because it extends the time, you know, and make sure that it's under contract. But you never ever want to take that into your personal name, because that's considered self-dealing if you try to assign that purchase and sale agreement to your IRA. Okay, so you have to notify the custodian and have that custodian enter into any type of an agreement with the seller of the property. Okay, I will tell you that with an IRA, in order to get that custodian's approval, a lot of times you do need a purchase and sale agreement. Right. And that's one of the times where you might need to use one, but the custodian has to sign it. And the buyer of the property would be the custodian name. Let's say Equity Trust, because a lot of people are familiar with Equity Trust. It would be Equity Trust Company, FBO, okay, for benefit of William Tingle IRA.
Okay, well, let me stop you right there.
Okay.
Because you know where I'm going with this one now. If I get a call today from somebody in foreclosure I've been playing footsie with for a month that says, I'm ready, let's do it, the chances of getting the Equity Trust, whoever, on the phone to work directly with me for an hour or two today are pretty dang slim. So what can I do to circumvent that whole issue there, that whole problem? I mean, it's got to be a way around it.
Well, therein lies the rub, okay? Because the custodian is the one that has to sign a purchase and sale agreement. Now, I will tell you what has been done, okay? This is old school, and you know it as well as I do. You just get the deed, and when you get the deed, you title the deed correctly, okay? And then you get on the phone with Equity and Trust, say, by the way, I've got a deed taken in the name of my IRA. I need to send it to you.
Okay.
Okay.
So
now that's one way. That's one way to get around it, but you could be taking a chance. The custodian is going to pretty much do what you tell them to do. They just like to do it in their own time.
Yeah.
Wherein lies the rub. Okay. But if you could go ahead and get the deed from Joni, all right, she'd be grantor, right? She'd be transferring the deed. And for grantee, you know how to title it: Equity Trust Company, FBO, William Tingle, IRA. Because when you get the deed, the problem is it depends on the state. So let me back up a minute. In my state, okay, here in Tennessee and in a few other states I'm aware of, North Carolina, South Carolina, the seller doesn't have to, the buyer doesn't have to sign the deed. It's the seller that conveys it over. Okay, so if you're in a state where the buyer does not have to sign the deed itself, it works really well. If you're in a state where the buyer actually has to sign the deed, then you may run into a problem because it does have to be the custodian that signs it. Okay. So some people say that you can get around that with having a checkbook LLC, and you may very well be able to. You'd have to just check and see if it worked in your state.
Yeah. Okay. So where would we go to check that out? I mean, we talk to a tax professional specialized in our state.
Well, you wouldn't have to talk to a tax professional. You'd have to talk to the custodian to find out and say, hey, when I get ready to get a deed, sometimes it's like really quick. What can we do to expedite the process? Right. Because it's really up to them. Your tax guy is not going to be able to tell you how soon your custodian can sign.
Yeah. So the checkbook LLC is a possibility, but again, custodian, wherever you have your Roth, would have to be the one to tell you if that's going to be okay.
Yep. Because even with a checkbook IRA, the advantage to a checkbook IRA is you can transfer the money, right? You're not transferring the money in a sub-2.
Right.
There is no money change. So that's not going to be a savings. It's just a matter of who can sign for that custodian. And you would never be able to do that.
Yeah. Well,
because it's self-dealing.
If you're in a case where someone is in foreclosure and there's $10,000 to cure the foreclosure, or it just varies. Some states that have a year-long foreclosure, they haven't made a payment in a year. You're going to have those. Right. Some say in Georgia, for example, where they can foreclose, like that. They may only be 2 or 3 payments behind. It may be, a couple of $1,000s.
And in that case, you would need money.
Right.
I was talking of a clean sub-2 deal, but you're absolutely right. You would have to have access to the money, and that money would have to come from your IRA account.
So just knowing that, if your intent was to put one of your deals a year or whatever the case may be in your IRA, you would probably want to identify that deal when it came along and say,
that's right,
this will be a perfect one because we're just taking over payments. There's no money to be paid out. We're just stepping in. So
right.
That would be
and usually the ones that we're talking about is a very clean deal where you don't have a very quick deadline. Now, I will tell you, I've never seen a situation where if you didn't give the custodian a heads up, right, let them know what was going on, that it took more than 24, 48 hours to get the paperwork done and the guy to sign it and all that kind of stuff. I really don't know of any cases that have an extended time there, because all it is a signature. They're not having to transfer money. They're not having to get all that set up. They're not having to wire anything, unless, of course, you are in a situation where you're clearing up an arrearage.
Yeah.
Okay.
Well,
but that's
things like DocuSign and all have made life a lot easier.
Yep. And you can use that.
In the old days, you had to FedEx and do that stuff, and there was a couple of days here and a couple of days there,
right. And we still got deals closed.
Yeah.
Okay. So that is the very first thing that you would do. Okay. Now, once the property is in the IRA, okay, and we say it's in, the property's still sitting there, but once the deed is in there, you've got to decide what you're going to do with that property, and then your exit strategy will sometimes determine what's going to go on from there, whether you're going to hold the property for a buy and hold. And I will tell you, that's where I think the greatest opportunity is, for an investor, is to hold, keep some of your holdings in there, because all the appreciation, once that appreciation starts, if you sell the property, you're not going to have to pay any capital gains taxes or anything like that until you start pulling the money out.
Right. So, but with a Roth IRA, now correct me if I'm wrong here, but everything that goes in, let's say that this property that I just bought and got the deed on and put it in the IRA, let's say that I sell this place with seller financing. I've spent no money. I took over the payments. I had a buyer immediately. They gave me a $25,000 down payment. I'm making $500 a month in cash flow. Every penny of that goes straight into that IRA, never to be taxed.
That is correct.
Okay.
That's the nice thing about a Roth.
Yeah.
That's true of a Roth 401k, the earnings, and it's true of a Roth IRA.
The Sub2 Deals Show with your host, Sub2 expert William Tingle. We'll be right back. Hey Sub2ers, do you want to learn how to get the deed but need a little help getting started? Want to learn how to fill out the paperwork, how to use a land trust, how to market for deals, how to negotiate with sellers, and more? Join us in the Sub2 Deals Facebook coaching group. Get the benefits of one-on-one coaching without the big price tag. Learn to do Sub2 right with coaching in a group setting and mastermind format. Head over to Sub2Deals.com right now and click on Consulting and Group Coaching. We'll save you a seat. Back to the show, the Sub2 Deals Show, with your host, Sub2 expert William Tingle.
So that $25,000 down payment was deposited directly into that account every month. Okay, so how do we handle this, Bill? Every month, does my custodian have to actually send the payment in to the mortgage company?
Yes.
Okay, so they'll be responsible for handling that. So they're almost like.
But what you can do, because I don't know of very many custodians who actually want to do that.
Right.
Okay. So what you can do is get a third-party escrow company to collect the monthly payment, pay the underlying loan, send the difference to the IRA.
Okay. Can you do that yourself?
No.
You can't. So in that instance,
you cannot do that yourself.
If this property is in your Roth IRA, you cannot self-service.
You cannot self-service.
Even if you use a management company in your structure.
Even if you use a management company in your structure, because that management company is probably one that you own. And if there is a company that you own 50% or more, it is a disqualified individual or disqualified person, and it cannot do business with your IRA.
Okay. So you would either have to set this thing up where your buyer mailed the check to your custodian, which they don't want to do. Correct. And then they have to write a check to the mortgage company. So in most cases, your properties in a Roth will need to go through a third-party escrow.
Yes.
Your buyer will pay the escrow company. The escrow company will send a check to your custodian and send a check to the mortgage company.
That's correct.
Okay. And you have to do all this because all of this is in the government.
That is the government. Yep, that's right. And so see, that's another thing where you have to decide, whether or not, it's almost like a cost benefit analysis.
Yeah.
Okay. Right. Is the benefit of this worth the cost? And the cost is not always monetary. Mm-hmm. A lot of times that cost is aggravation.
Oh, I got you. I understand.
Now, we were talking about which is best, the Roth, 401k or the Roth IRA. Okay. Mm-hmm. So here's the thing. You can be the administrator and the trustee of your Roth 401k plan. Okay, which means you could collect all that yourself, but you would have to do it in the name of your 401k plan. right? And
Mm-hmm.
administer that. That's why, everybody says, well, why is that different than the IRA? Well, that's because the plan is kind of IRS ruled, right? You have to qualify, you have to follow certain conditions and stuff like that, but there's a lot more flexibility as to your involvement with the 401k.
Right.
Okay. The only problem is, that 401k, you can't have a solo 401k if you're the only employee, right? But then if you have other employees and stuff, they may get pulled into it. So again, it's going to be a cost benefit analysis, and you got to look and say, how many deals am I doing in my IRA, and what is going to be the pain factor of having that money to have to go to a escrow company, them take care of it and send it to the IRA custodian, blah, blah, blah.
Yeah. Hmm.
The wonders of our government.
And I'm working right now trying to figure out how to simplify that and how to.
I know you are.
How to move around it. I'm guessing any third-party escrow company that you were involved with in any way would be a problem.
50% or more.
Yeah, 50% or more. So if you, well, I don't know. I don't want to get too complicated in this thing today, but it sounds like even with, and I get the pros and the cons on the thing, but it sounds like even with the administration and everything else, that the IRA probably is the simplest.
It is the simplest, yes.
Yeah. And the benefits, I guess, overall are the same. I guess because I don't like a third-party escrow company in general. I just don't like it.
I know.
I think, and this is what I usually tell people: by the time you pay another company $50, $75, $100 a month, and I've heard all the prices, just to take one check in, send 2 checks out. It's okay if you got a couple of properties, but you got 50. You could hire a full-time employee that could do a lot more for you besides just handling a few pieces of paper.
But you can't. So that's the thing about it is if you're going to do this, you need to factor in that additional cost per month,
right?
Into those expenses and into the rent. Or you can just say that, hey, guys, you're going to have to pay the escrow company. But I will tell you, when you're working with the buyer or somebody like that, they don't want an escrow charge tacked on to their regular monthly charge. You've got to kind of incorporate it into what all is going on.
Yeah, that's, it's easy to say, well, we'll just pass that fee on to the buyer. You're already charging them a premium probably as far as interest rate goes and other things.
Yep.
And there's only so many costs the buyer can absorb.
Yep. And there are a few escrow companies out there that will do it for $45 or less. So they're not all $100 or $75. That I don't like $45.
Yeah.
But I would, if I had to pay $100, I'd probably be looking for another escrow company.
Yeah, that's right. Well, but I guess again, if you're only going to put 1 or 2 deals a year in there, the cost overall is not that great. If that's what you've got to do to comply, to save, I mean, my goodness, what would be, let's say, the typical deal that we take over and sell with seller financing, we're going to make $50,000 on over the course of 3 or 4 years. What would be the taxes on that for most of us?
Well, you usually look at 20%.
Yeah. So,
depending on what your marginal tax bracket is, but I mean, that's a good guess.
Yeah. So you're looking at saving $10,000 over the course of 3 or 4 years, paying out whatever, $1,000 or so. So, I mean, overall, I guess it's a better thing. It's just one of those things that it's just a pain in the butt. It kind of ticks you off a little bit to have to do it.
Yep. I do not disagree.
It's just something about being forced into doing something that makes you not want to do it. You know what I mean?
I know exactly what you mean.
That rebel thing.
Always ask me to do something. Don't ever tell me that I have to do it.
Right. Okay. So, and I knew we were going to go off on some tangents in this because it's a little bit complicated and new to most people. But okay, so we've decided on a Roth IRA. That's what we're going to do. We've got a custodian. We've dealt with the custodian having to sign the sales agreement, getting the deed, doing that sort of thing. we finally broke down and hired a third party to handle our payments for us. And this thing has rocked on for 2-3 years. And our buyer raises their hand and says, hey, we've been approved for our refinance. We're ready to go do that. They go through the process, get refinanced. We've got another check waiting for us for $25,000, $30,000. But during this process, any management with that particular property, any dealings that had to be done, maybe the buyers got behind on payments a time or two, or just interactions. Is there anything preventing us as the note holder from dealing with that?
Yes,
that
because
buyer?
you're not. Yeah, because you're not the note holder.
Okay, so how? Well, technically the IRA is.
Right. That's
But
correct.
how
And
do
that
you?
and see that's there is a big distinction there.
Yeah,
You would
right,
if you're going to require any property management,
right.
okay? If it's ongoing property management, say it's a rental property,
Mhm,
okay, or you're doing a lease option property, right? You can hire a property management. Well, you can't. You can have the custodian hire a property management company to
mhm,
collect all those rents, pay all those expenses. They can even pay the underlying loan for
mhm,
you if they'll agree to do that, right?
mhm.
So, but it cannot be a property management company that you own 50% or more. You can
Right.
approve the employment of the property manager. You can say, this is the property management company I want you to use. The property management agreement has to be signed between the IRA custodian and the property management company.
Right.
And they can
Okay.
do all of that. They can do evictions. They could do a foreclosure if you needed them to. You can appoint an attorney,
Mhm.
right? Have the property management or have the custodian employ the attorney to handle the foreclosure and stuff,
But
because
even
that's who would have to do the foreclosure.
even the buyer screening process, we cannot be involved in.
You cannot be involved in that.
Okay. So using a mortgage broker like we do anyway would be the perfect way to handle that, wouldn't it? So we advertise this property we've got for sale. And the reason I'm asking these questions is because when you start doing a few deals in an IRA, the way that you're normally used to running your business, this particular one,
Doesn't
all
work
of that's out
anymore.
the window.
Yeah, doesn't work anymore.
You
Now,
can't.
there is, I will tell you, William, there is some debate, okay, on the administrative part and
Mhm,
what is classified as administration, okay? Because theoretically, the um, the administrative part, if you're the owner of the IRA, right,
mhm.
there's some administrative functions that you can do and others you cannot do, okay? The problem and the reason that I and most of the folks that I know say just don't do any of it is because there is a fine line on there, and once you start doing it, it's easier to fall over that line,
Oh yeah.
right? What is the difference between approving a property management company and approving every single bill to get paid? You know what I'm
Mhm.
saying?
Right.
So that's why most of us will say don't do anything
Mhm.
that can be hired out. And
Right.
that used to be the rule that everybody went by. If you can hire somebody to do it, okay, and they would get paid to do it, then don't you do it for free, because that's considered self-dealing. Because if you're doing
Right.
it for free, it's saving the IRA from having to pay someone to do it, if that
Mhm.
makes sense.
Yeah. Okay. All right. Well, like I said, I'm trying to wrap my brain around how difficult that would be and what the shortcuts would be to get things done.
And whether it would work or not.
Yeah, that's right.
And you know what? One way to kind of find out is to talk with the IRA custodians, because most of them, if you say, hey, I want to do a Roth IRA, I'm a passive real estate investor, this is what I usually do. What's the best way that we can work together, and what's the best way that we can get this set up? They'll usually tell you, because they've been
Yeah.
around the block. Now, there are some who would not know what you talked about. They're old school IRA folks,
Mhm.
right? So you need to talk with a self-directed Quest, a very good one. They're out of Texas. Equity Trust is much better than it used to be. There's one called Advanta. There's one called New Direction. Those are all good, and they've got a wealth of information on their websites. You can just go in and you can search for checkbook checkbook IRA or what have you,
Mhm.
and they've got a lot of info on when it works best and when it doesn't.
Right. Okay. All right. Well, that sounds good. So, all right. So what we've heard here so far is if you're a sub-2 guy, and that's what you want to do, the kind of scenario that we've talked about, whether you get the deed on them and you either rent them out or sell them with seller financing, an IRA is probably uh, the least complicated,
Yep.
easiest
I
to
would
set
go, yep.
up.
I would go
Yeah.
with the Roth IRA because they're not going to be looking for annual contributions. They're not going to be looking for a contribution every single year.
Mm-hmm.
Okay. A lot of times with anything that's like 401 and traditionally employer sponsored type stuff, okay, even though they may not be required, they pretty much are going to look and say, why did you set this up and made one single contribution of X amount of dollars and you never contributed anything else to it, and you're a business, right?
Okay, so an IRA is going to be the simplest. The best property to put into this IRA, if you're going to do one or two a year, is going to be a very clean one where there are no arrears to be paid. Just one where you're stepping in, take over the payments, no to very little repairs, just something very clean. You take over the payments, you put your buyer, your tenant in like that. That's going to
That's
be the best one.
always going to be the easiest because yes, you can take a property and have it conveyed into an IRA, and it might have to be rehabbed.
Right.
Okay, but you can't do any of the rehab work,
Right.
which I wouldn't
And
want to anyway. So that's not going to be any biggie for Bill because I don't swing hammers. But there's some people who like to do this. I've got one guy who he hated to hear me say it, but he owned a construction company.
mhm.
Okay, and he was using that construction company to do the work on properties he took into his IRA. And somebody told him that as long as he didn't do the work and just approved of the work that they did, that it was okay
Yeah.
for him to be an approval process. What they didn't convey to him was that if he owned 50% or more of that rehab company, that it was a disqualified person and it could disqualify his entire IRA account.
Yeah. Oh, yeah. And that's the thing that concerns me the most about it is in talking with you. I mean, it sounds like every component of this transaction has got to be completely different. I mean, than what we normally do.
It
Um,
is.
I mean, technically, I guess you're not supposed to talk to your buyers. I mean, they would call someone else about information on the property. It's
Well,
just a
now you
matter of,
can you can talk to the buyers.
right,
You can't just go into any paperwork with them.
right. No
Okay.
agreements or anything
You
like
can't do any of the agreements,
that.
but
Okay.
you can
Okay.
talk with them and you can do the negotiation. That much
Right.
is okay for you
Okay.
to do,
Okay.
right? But you're again having to have your custodian sign the purchase and sale agreement.
Right. Okay.
So it's a little bit different. So the rough rule of thumb there is you can do anything you want to with the buyer except sign paperwork.
And the same with the seller, I suppose.
Your name cannot be on the paperwork.
Okay. And so I'm guessing also, since it has to be titled a specific way, use of a trust for privacy is out the window.
Oh yeah, in this case, yeah, you wouldn't.
Yeah.
Because the
I mean,
deed your name is going to be on the deed.
exactly. So,
Whether you like it or not, because even though the deed goes into the name of the custodian, it goes FBO, which is for benefit of, right? And then your
right.
name is on there and your IRA account is on there. Okay.
Yeah.
Which of course, you're only doing one here and there and stuff like that. So it's really not going to be a super big deal because you don't really have any liability on it.
Right.
Right. So it's not as bad as having like 10 or 15 investment properties listed.
Right. Well, let
somewhere.
me ask you this, and I'm sure I know you're not. I don't think you're a lawyer, Bill. You're everything else. You're not an attorney as well, are you?
No.
Okay. But as far as
and I wouldn't tell you if I was.
you said there's no liability, so your chances of getting sued and being found liable if it's a rental property, I guess, or you're not liable if your IRA is actually, or your custodian's actually the owner.
That's correct.
Okay.
Because you don't own because you don't own the property.
Right. So you don't have to worry about those things.
Right.
All right. Well, that's cool. All right. So, okay. So gosh, the Roth IRA is probably best for us sub-2ers, a very clean transaction, and you have to be pretty much hands off except for talking.
Correct.
You can talk, but you can't contract.
That's right.
Okay. And your recommendation, I know there's several, and you mentioned them, several custodians. What would be, if you had to choose one today for yourself, who would it be?
I would take a strong look at either Quest, if you're around Texas in that part of the world, okay, or Advanta, if you're on the East Coast. Advanta is in Atlanta, right. Georgia.
Advanta,
those are my top.
Atlanta.
Yeah, Advanta in Atlanta. Those are my two top picks.
Okay.
Okay. Right. Quest has been around the longest.
Mm-hmm.
And I mean, they've been around quite a long time. It used to be Quest and Equity Trust, right? Those were the two most well-known as far as we investors are concerned, right? But Advanta's given them all a pretty good run for their money. And then, of course, there's a lot of others that we don't even, doesn't rise to our level because they don't do that much with real estate.
Right. Okay. And most custodians all are friendly as far as the checkbook LLC thing goes, or no?
I am not aware of any of the companies who are not, because that's just, the world they live in. Okay. I know that Quest and Advanta are very easy to work with in those regards.
Okay. All right.
And I guess what you mean, are there some who would prefer that you not ever do a checkbook IRA? And there are some, even though they have them available, there's some who really don't like them because they don't have the control that they would like to have.
Well, they don't get that fee every time a check's written either.
Right.
I mean, and that's just, the truth of the matter is that every time a piece of paper changes hands.
Oh yeah, you have to pay for it.
Yeah.
Yep. You have to pay for it.
Every time they write a check or anything else, I mean, there's a fee associated with that. And when you have that control, plus, I understand that part of their concern may be that you may not handle things properly, and then your whole account is, I guess, disqualified.
Oh yeah, and that's really,
yeah.
That's really not a good thing, because basically what they do is whatever the value of your IRA account is on the first day of the year, that's all taxable income to you if it gets invalidated. Also, not only that, there's a 15% penalty of the balance, right? So it's all taxable and subject to your tax rate. There's a 15% flat penalty of it. And if you are under 59 and a half, there's an additional 10% penalty on it. So you could lose 25% right off the top, and then all of it, including that 25%, is reported as income. Yeah, that's killer, man.
Yeah, that's pretty stiff.
And it's designed to keep people from, being tempted to deal with disqualified persons.
Right. Okay. Well, Bill, like I said in the start of this thing, you know how I am about tax stuff, but I know you know this stuff inside and out, and anyone that is interested in IRAs or how to set these things up or what to do, I know that you consult with people and do that sort of thing. So
we do that.
You want to tell everybody how they can get in touch with you to do that?
Sure. They can reach me through email at bill@billwalston.com. I'm always available on Facebook, and most people, if we're friends, they just hit me up with a private message, and that's fine. That's an easy way to get up with me. So those are two of the best ways.
Okay. You have a website too, don't you?
billwalston.com.
Okay, great. All right. Well, man, I appreciate the heck out of you coming on here today and confusing me.
Confusing the rest of you?
Further. about this IRA stuff.
Yep. And I think what it boils down to is we just want people to be aware that it's a good investment vehicle, even for real estate investors. Depending on your individual circumstances and where you are in your business, 401k Roth or Roth IRA are going to be the best choices for those types of vehicles of investing.
Okay. Well, thanks again for being here on our first episode of the Real Expert series. Appreciate you coming in and talking with us.
I'm happy to be here, man.
Thanks. Well, Sub2ers, that is it for this episode of the Sub2 Deals Show. You can find the show notes for this episode along with a complete transcript at sub2podcast.com. If you enjoyed this episode, we would love it if you would subscribe and give us a 5-star rating and review on Apple Podcast. And if you haven't yet, you can join our free Facebook group at sub2forum.com. So until next time, keep learning, keep talking to sellers, and you will buy some houses.